Hello, friends. If you are 62 or older and you own, rent, refinance, or live in an HOA governed home right now, there are housing fees on your paperwork that the law either caps, limits, or bars entirely. 6 categories, and on just one of them, a single VA refinance closing, the charge can be $9,900. Not the loan, not the down payment, the fee. And the veteran who owed it may have qualified to pay zero. That fee was on the paperwork. It looked correct. It was not. That is the pattern across all 6 of these. The charge shows up on a loan estimate, a rent ledger, or an HOA notice, and unless you know the rule, you sign it and the money is gone. Hello, friends. That number I just mentioned is not theoretical. It is sitting on real closing documents, real rent ledgers, and real HOA letters right now. And it is not one fee. It is a pattern that runs across mortgages, homeowner associations, and rental agreements. Places where the law either caps the charge, requires a process before they can collect, or bars the fee entirely. 6 categories. Grab a pen. Mark the ones that apply to your situation because at least one of these does. And on several of them, the protection has been there the entire time. Now, these rules move through VA loan handbooks, HUD regulations, and state housing statutes. The people subscribed here hear about them before the money leaves the account. If you are not subscribed, you are finding out late. Subscribe now and let's get into it. Before we go further, I need to address something, because people hear a topic like housing fees and immediately sort themselves into one of 2 groups. The first group owns their home. Maybe it is paid off, maybe they have equity and a comfortable retirement, and they figure a video about fees is for people in real financial distress. The second group is renting or refinancing or staring at an HOA bill on a fixed income, and they have learned to assume the law never actually bends in their direction. Both of those assumptions are wrong about at least one of the items I am covering today, and on every single one I will tell you exactly which group it helps most and why. Some of these are federal mortgage rules, some are state housing laws. A few of them will surprise the homeowner who thought this was not their problem, and a few will surprise the renter who thought the landlord's number was final. And stay to the end, because the last one is the fee people assume landlords can set any way they want. And in some states, that is simply not true. It is one of the easiest to check against your own ledger. Here we go. Number 1, VA home loan fees that some veteran borrowers do not owe. Most people assume that if the lender put a fee on the loan estimate, that fee is correct. It is on the paperwork, so it must be right. That assumption can cost an eligible veteran thousands of dollars at closing. Here is how the VA funding fee actually works. When you use a VA-backed home loan, the Department of Veterans Affairs charges what is called a funding fee. On a first-use purchase or regular refinance, that fee is 2.15% of the loan amount. After first use, it jumps to 3.3%. On a cash-out refinance, the same rates apply. 2.15% first use, 3.3% after. On an IRRRL, that is an interest rate reduction refinance loan, basically a VA streamline refinance, the fee is 0.5%. But here is what most people miss. If you are receiving VA compensation for a service-connected disability, or you would be receiving it but for retirement pay, or you are entitled to receive it based on a pre-discharge exam or review, or you are a surviving spouse who meets VA eligibility criteria, you may owe none of it. Not a reduced fee. 0. Now, who does this help most? Both groups. The veteran on a fixed income needs the closing cost relief right now. But the comfortable retired veteran is often the one who assumes the exemption question was already handled somewhere in the paperwork. It frequently was not. Let me give you the math. On a $300,000 VA cash-out refinance after first use, 3.3% is $9,900. That is not a monthly charge you chip away at. That is $9,900 due at closing. And on the origination side, VA lenders are generally capped at a 1% origination charge, which on $300,000 is $3,000. So these are real numbers on real closing documents. A veteran I heard from was reviewing a refinance and nearly signed off on a fee he did not owe. His name was Walter, 72, out of Jacksonville, retired Navy machinist. He was lining up a $300,000 VA cash-out refinance. The funding fee on his estimate was $9,900 because the lender treated the loan as after first use and non-exempt. He stopped the file. He asked the lender to confirm whether his VA disability status made him exempt, using the Certificate of Eligibility process and the VA Specialist line. The outcome, $9,900 avoided at closing. Not reduced, eliminated. And here is something else. If you already closed and you later receive a disability compensation award retroactive to a date before the loan closing, that funding fee can be refunded. The cleanest win is catching it before you sign, but the door is not always shut after. Here is your action step. Review your loan estimate and closing disclosure for the VA funding fee line and the origination charge. Contact the VA Home Loan Specialist at 1-877-8273-702 or use the COE process through VA Form 26-1880 to verify your exemption status. Use the exact words. Please confirm whether my certificate of eligibility shows me exempt from the VA funding fee, and if not, what evidence you need before closing. Do this before closing day. That is number one, and that one hits before the ink is dry. The next one keeps draining money long after closing. Number two, reverse mortgage fees that HUD actually caps. There is a belief that reverse mortgage fees are whatever the lender decides to charge, that the lender names a number and you either take the loan or you do not. That is not how it works on a HECM, a home equity conversion mortgage, which is the FHA-insured reverse mortgage most borrowers encounter. HUD sets a formula for the origination fee. It is the greater of $2,500 or 2% of the first $200,000 of what is called the maximum claim amount, plus 1% of anything above $200,000. And the whole thing is capped at $6,000 unless HUD publishes an adjustment. The 2026 maximum claim amount is $1,249,125. That cap matters because it means even on a high-value home, the origination fee has a ceiling. Then there is the servicing fee, the monthly charge the servicer takes for managing the loan. HUD historically limited that to $30 per month for fixed-rate or annually adjusting HECMs and $35 per month for monthly adjustable HECMs. Who does this help most? Both groups. People think of reverse mortgages as a last resort, but fee caps matter just as much to the homeowner tapping equity strategically as they do to the homeowner tapping it out of necessity. The fees compound either way. Here is the math on just the servicing side. A $35 monthly servicing fee sounds like nothing. Over a year, that is $420. Over 15 years, that is $6,300. On a loan where the balance is growing, not shrinking, every dollar of fee gets added to what you owe. That $35 is not standing still. Here is your action step. Before you sign, get the exact origination fee formula and the monthly servicing fee in writing. Call a HUD-approved HECM counselor through the Housing Counseling Hotline at 1-800-569-4287. Use the exact words. Before I sign, I want the exact origination fee formula, the monthly servicing fee, and which loan features control that servicing amount. Counseling is required before your application can be processed, so use that session to pin down every number. That is number two. Those were federal mortgage rules. Now let's move into the place where older homeowners with good equity get blindsided anyway. Number three, HOA assessment rights that force the board to give you a process. Now everything I have covered so far has been about mortgage fees, charges tied to borrowing. This next one is different. It is not about a fee being too high. It is about leverage. And this is where the comfortable retiree usually tunes out, because they assume process protections are for people in financial distress. That assumption is exactly backward. If you own a home in a homeowner association and the board passes a special assessment, say $2,400 for a roof repair fund, most people assume that if the board says pay it in a lump sum, that is the end of the discussion. In some states, it is not. In California, before the HOA can even record a lien for delinquent assessments, they must provide at least 30 days written notice by certified mail with specific required details. If you, the owner, submit a written request to meet with the board within 15 days of that notice's postmark date, the board must meet with you within 45 days of the postmark. And here is the part that matters most. Additional late fees do not accrue during a compliant payment plan. In Arizona, the protections run even deeper on the collection side. The HOA must provide written notice at least 30 days before referring your account to an attorney or collection agency, and they cannot foreclose unless you have been delinquent for 1 year or owe $1,200 or more. For a planned community, that threshold rises to 18 months delinquent or $10,000 owed. The association must make reasonable efforts to communicate and offer a reasonable payment plan before foreclosure. Who does this help most? The comfortable homeowner. That is the surprise. This is not a hardship program. This is a process right, and it matters precisely because even financially stable retirees can be pressured into bad lump sum decisions when the letter arrives and feels like a demand with no alternative. Here is the math. A $2,400 special assessment demanded at once is a crisis on a fixed month. Spread across 12 months under a negotiated payment plan, it becomes $200 a month. Same money, completely different event. Here is your action step. The moment you receive a delinquency notice or a pre-lien notice from your HOA, send a written request to meet with the board and request a payment plan. Send it by certified mail or trackable written delivery. Use these words. This is my written request to meet with the board to discuss a payment plan for the assessment debt noticed on, and then state the date. Please confirm the meeting date and the association's payment plan standards. In California, you have 15 days from the postmark to trigger that board meeting timetable. In Arizona, the 30-day pre-collection notice is your window. Check your specific state's rules because this is state law, not federal. That is number 3. None of this is automatic. The HOA does not volunteer a payment plan unless you ask. The process right only exists if you use it. That was the homeowner side. Renters get hit differently, and the next one is quieter because it is broken into small charges. Number 4, repeated rental application fees that some states do not let landlords keep charging. If you have applied to rent an apartment recently, you know the drill. Every application comes with a screening fee, $45, $55, sometimes more. Apply to 3 places and you have spent over $150 before you have a lease. Most people assume every application means a fresh fee, no matter what. In some states, that is wrong. In Oregon, a landlord may require payment of only one screening charge within any 60-day period, regardless of how many units that landlord owns or manages. One fee. One 60-day window. If you applied to a different unit run by the same company 2 weeks later, they cannot charge you again. The screening charge also cannot exceed the landlord's average actual cost or the customary amount charged by a screening company, and the landlord must give you a receipt. If the unit is filled before screening or you withdraw in writing before screening begins, the landlord must refund the fee within 30 days. In Washington, a different protection applies. Landlords must disclose whether they accept a reusable tenant screening report. If they say they do and then run their own screening anyway, the applicant cannot be charged for the landlord's report. A violation can expose the landlord to up to $100 in liability. Who does this help most? The fixed income renter. Repeat screening fees hit cash flow immediately, especially for someone relocating after a spouse passes, after a rent increase, or while downsizing. These are not large charges individually. They are large charges in sequence, and that is exactly how they slip past. A woman I heard from in Oregon had one of those situations that feels routine until you read the statute. Her name was Linda, 67, out of Salem, retired bookkeeper. After a lease non-renewal, she applied to 3 units managed by the same operator within 2 months. She paid $55 each time. That is $165 total. Under Oregon's one charge within 60 days rule, only one of those fees was lawful. The excess was $110. And the statute goes further. A violation can expose the landlord to twice the amount charged plus $250. Linda wrote to the property manager, asked for the screening fee receipts, and pointed to the rule. Here is your action step. Ask for the receipt and the prior charge history. If the same landlord group charged you more than once inside 60 days in Oregon, put it in writing. Use these words. I applied to another unit you manage within the last 60 days. Please confirm whether this screening charge complies with Oregon law and send the screening receipt. The 30-day refund window and the 60-day single charge rule are your reference points. Check your own state's rules because these are state-specific protections. That is number 4. The property manager does not refund repeated screening fees out of kindness. You have to know the rule and say it out loud. Repeated application fees are the warm-up. The next layer is the money they try to take before you even get the keys. Number 5. Move-in fees and deposit add-ons that some states bar outright. When the rental market is tight, landlords sometimes pile charges onto the front end. A move-in fee, an application fee, an administrative fee, a processing fee. It feels like the cost of doing business. In some states, several of those charges are flatly illegal. In Massachusetts, state law limits what a landlord can collect at or before the start of a tenancy to 4 categories only. First month's rent, last month's rent, a security deposit equal to no more than 1 month's rent, and the actual purchase and installation cost for a key and lock. That is it. The Massachusetts Attorney General's office has said a landlord may not require a broker fee, application fee, move-in fee, background check fee, credit check fee, or any amount beyond those listed categories, subject to limited exceptions in newer law. Who does this help most? The fixed income renter. Upfront junk fees are a direct barrier to moving. When rent is $1,800, the lawful security deposit cap is 1 month, $1,800. A $300 move-in fee and a $75 application fee on top of that create $375 in extra upfront charges that the law does not allow. The legal deposit is 1 month's rent. The extra move-in fee is where the junk starts. Here is your action step. Demand an itemized list of every upfront charge before you sign, and compare each line to the narrow category list in your state's statute. Use these words. Please itemize which of these charges are first month's rent, last month's rent, a security deposit not exceeding 1 month's rent, or the actual purchase and installation cost for a key and lock. If any charge does not fit one of those categories, that is your red flag. Massachusetts AG tenant rights materials are available if the landlord does not correct the ledger. That is number 5. The landlord does not strike the move-in junk fee because it feels excessive. The fee stays until someone names the rule. And the last one is the charge people feel too embarrassed to challenge, which is exactly why it keeps getting overused. Number 6. Late rent fees, where state law puts a real ceiling on the number. This is the one I told you to stay for. Most people believe a late fee is whatever the landlord wrote into the lease. The lease says $150 for a late payment, so $150 it is. In some states, the lease does not get the last word. The statute does. In Colorado, rent must be late by at least 7 calendar days before a late fee can be imposed at all. Not 1 day, not 3 days, 7. And when the fee does apply, the maximum is the greater of $50 or 5% of the past due rent. On $1,600 rent, 5% is $80, so the cap is $80. On $900 rent, 5% is $45, so the statutory floor makes the cap $50. The landlord must provide notice of the late fee within 180 days after the payment became due. And here is the line most people do not know. The landlord may not evict solely for failure to pay late fees and may not charge interest on late fees. Who does this help most? The fixed income renter. A capped late fee matters most when one disrupted month turns into a rolling ledger problem. If the fee is unlawful, every month it repeats, the overcharge grows. Here's the math. If a landlord charges $150 on $1,600 rent when the legal cap is $80, that is $70 too much. If that happens 6 times in a year, the overcharge is $420. On a fixed income, $420 is not a rounding error. It is grocery money. Here is your action step. Compare the late fee on your ledger to the statutory cap and the 7-day threshold. Put it in writing. Use the exact words. My rent was not 7 days late, and Colorado limits late fees to the greater of $50 or 5% of the past due rent. Please send an updated ledger. Check your own state's law, because Colorado is the example here, not the only state with a cap. The 7-day grace threshold and the 180-day notice limit are the numbers to reference. That is number 6. And that is the full list. So here's the full picture. The VA funding fee that some veteran borrowers should not pay at all. 1 check of your certificate of eligibility before closing. The reverse mortgage origination and servicing charges that HUD actually caps. 1 counseling session with the numbers pinned down in writing. The HOA assessment notice and payment plan process that can stop the lump sum panic. 1 written request within the notice window. The screening fees landlords cannot keep repeating in some states. 1 letter citing the statute and asking for the receipt. The move-in junk charges some states do not let landlords pile on. 1 itemized demand compared to the category list. And the late rent fee cap that turns a vague penalty into a number you can check against your own ledger. 1 sentence in writing. Now here's the part I need you to sit with. The lender does not stop the VA fee automatically, just because you think you are exempt. The reverse mortgage paperwork does not simplify itself. The HOA does not volunteer a payment plan unless you ask. The property manager does not refund repeated screening fees out of kindness. The landlord does not strike the move-in junk fee because it feels excessive. The ledger does not correct its own late fee. Being legally protected from a charge and actually escaping it are 2 different things. The gap between them is information. So here is what I am asking you to do. Think of 1 person, a widowed neighbor looking for a new apartment, a veteran couple lining up a refinance, a homeowner staring at an HOA letter on the kitchen table. Send this to that person. Not because they are struggling, because the odds are good they are treating at least one of these charges as unavoidable when it is not. Subscribe, share this with someone you know who owns a home, rents, or is refinancing right now, and I'll see you in the next one.